Dr. Subbarao, the RBI governor, carries the impossible burden of reconciling high inflation with falling growth. He has to achieve this essentially by setting a magical interest rate without requisite support from the government on fiscal measures. With IIP falling to negative territory and consumer price inflation running over 10%, wisdom of further rate cut is being questioned by analysts. Gov's dilemma becomes more apparent if you consider RBI minutes which evidences split opinion in the rate-setting committee. Plenty of members favored slower descent when Subbarao pushed through a surprise rate cut of 50 basis points in April. It is possible that the lame duck government will fight back after the budget session by increasing fuel prices. Haven't they promised to Fitch, the rating agency, to reduce subsidies to 2% of GDP? Hopefully, Congress is prepared to bear the brunt of the resultant political firestorm, particularly from its redoubtable ally, TMC. How it's going to impact the selection of presidential candidate is another matter. Brexit, the latest buzzword to hit the headlines, is clearly at the center of global markets. The recent spate of election results in Greece, France, and Germany have demonstrated the popular anger against austerity. It seems to us at Percentage Play that replacement of Sarkozy by Hollande has weakened the Franco-German line of fiscal compact and is shifting the debate towards growth as opposed to austerity. The G8 meeting this weekend at Camp David will be keenly watched for signals. If the outcome tilts more towards growth, as is widely expected, it could mean better tidings for global markets, currently hallucinating over a disorderly Greek exit from euro and its inevitable fallouts of possible civil unrest in Greece and a contagion across EU members. It could arguably be a longer road to full recovery, but politically tolerable to the belligerent Greeks on the street. In any case, the cost of Brexit in terms of write-offs and possible shoring up of ECB finances by member states could far exceed a softer approach to the unfolding Greek tragedy. Meanwhile, back home, rupee is at an all-time low of 54.45 to a dollar, adding to the inflationary pressures as cost of imports go through the roof. Mercifully, global commodity markets have been soft, especially crude oil, Brent having hit a low of $105 last week, somewhat offsetting the sharp devaluation of the rupee. With no enthusiasm from foreign investors, any directional change in rupee looks rather distant. No wonder equities are comatose. At 4900, thanks to an intraday relief rally sparked by State Bank results on Friday, Nifty still looks susceptible to a lower bottom until global equities signal a temporary ceasefire. The next stops clearly are 22nd May, the end of budget session, 17 June, Greek parliamentary elections, and 18 June, RBI's next monetary policy meeting. While the market looks technically poised for a rally, I believe a second bottom in the short term is more than likely. And that bottom, depending on whether it qualifies as a higher bottom or shows up a positive divergence in momentum indicators, could spark a sustainable rally depending on what happens on the milestone dates. Percentage Play's strategy for the coming week will be to watch out for follow-up support to Friday's intraday reversal. In case it materializes, we may be looking for some quick swings in our competitive value fund. We also have a healthy appetite for taking on new pairs in our quant pair fund, which make it through the filters of our proprietary algorithm. Meanwhile, outperformance levels of Percentage Play Competitive Value Fund and Percentage Play Quant Pair Fund against Nifty continue to be over 15% and 35% respectively.